estate investors hear about the same tax strategies: cost segregation, bonus depreciation, short-term rentals, real estate professional status, and 1031 exchanges. But here's what most people never hear, because knowing about the strategy isn't the hard part. Knowing whether it will actually work for your situation is. I'm Lisa Marie Odeja, CPA, EA, and a former federal government auditor. And I specialize in advanced tax planning for real estate investors who are looking to reduce taxes, build wealth, and keep more of what they earn. Today, I'm going to walk through 5 of the most talked about real estate tax strategies, explain what they do, where investors get stuck, and how strategic planning can help unlock those benefits. And make sure you stay until the end, because I'll share the biggest mistake I see investors make when pursuing tax strategies. And it's often one of the easiest to avoid. Let's start with one of the most popular strategies. Strategy number 1, cost segregation. A cost segregation study allows certain parts of a property to be depreciated faster instead of over the standard 27.5 or 39 years. Now, that means larger deductions sooner, and for many investors, that can create substantial paper losses. Those losses may potentially help offset other forms of income and reduce taxes when the rules are met. In other words, an investor may be reporting a loss on the tax return, even while the property is still generating positive cash flow. That's what gets investors so excited about this strategy. Sounds great, right? Well, here's where many investors get surprised. Generating the deduction and actually benefiting from the deduction are 2 very different things. Because if the loss becomes trapped under the passive activity rules, those deductions may not reduce your current taxable income at all. So, the real question isn't, can I create the loss? The real question is, can I actually use the loss? This is actually one of the most common situations that I help real estate investors navigate. Creating the deduction is usually the easy part. Determining whether you'll actually benefit from the deduction is where strategic planning becomes very important. If you'd like to explore how these strategies may apply to your situation, you can schedule a consultation using the link below. And that brings us to the next strategy. Strategy number 2, short-term rentals. One of the reasons short-term rentals have become so popular is that under the right circumstances, they may allow investors to treat those losses differently than traditional rental losses. That's why you hear so much discussion about Airbnb properties and vacation rentals. Many investors hear about the short-term rental strategy and immediately assume all they need to do is buy an Airbnb. Well, that's not exactly how it works. Participation matters. The IRS wants to see meaningful involvement in that activity. So without sufficient participation, investors may discover that the tax benefit doesn't work the way they expected. However, when short-term rentals are properly structured, they can become one-way investors' attempt to make those losses more useful. But short-term rentals aren't the only approach. Investors with larger portfolios often begin exploring another strategy. Strategy number 3, real estate professional status, also known as REPS. Real estate professional status is one of the most discussed tax strategies in real estate. Many people hear about REPS and immediately assume it allows unlimited write-offs. That's not exactly how it works. The reason REPS receive so much attention is simple. Rental losses are normally considered passive. But when investors legitimately qualify, those passive losses may potentially be treated as non-passive and used to offset other forms of income, thereby reducing taxable income. That's a powerful benefit. But qualifying is often more difficult than social media makes it sound. The strategy depends heavily on time, participation, and documentation. And documentation is where many investors run into problems. If the IRS ever questions the position, you'll need to demonstrate that the requirements were actually met. And that's why successful investors focus just as much on documentation as they do on the tax savings. But once investors understand how to potentially use losses, another question often follows. And that is, how do I create even larger deductions? That brings us to strategy number 4, bonus depreciation. Bonus depreciation is often mentioned as if it were a tax strategy by itself, when it's really more of an accelerator. Bonus depreciation allows certain assets to be written off much faster than traditional depreciation schedules. And that is often what creates the large deduction investors see promoted online. But here's what many people miss. The bigger deduction isn't always a bigger tax benefit. The real objective is not simply creating losses. The objective is creating losses that can be used effectively, because a deduction that produces no tax benefit today may not solve the investor's actual problem, which is why tax planning should always begin with the investor's goals first, the strategy second. And that leads us to one final strategy. Strategy number 5, 1031 exchanges. A 1031 exchange is one of the most powerful long-term wealth-building strategies available to real estate investors. Instead of immediately recognizing taxable gain when selling an investment property, investors may be able to defer taxes by reinvesting into another qualifying property. This can help you to preserve capital, increase purchasing power, and support continued portfolio growth. But here's what I want investors to understand. The real value isn't the exchange itself. The real value is having a plan before the sale occurs, because once the transaction closes, many planning opportunities disappear. And that's true not just of the 1031 exchanges. It's true for nearly every tax strategy we've discussed today. In fact, I recently worked with an investor who believed her only option was to sell a property, pay a substantial capital gains tax bill, and move on. But after reviewing her entire situation, it became very clear that we weren't just dealing with taxes. And that changed the conversation completely. We were able to identify planning opportunities that addressed multiple goals simultaneously. If you'd like to hear that full case study, I've covered it in a separate video on my channel called How We Legally Avoided the Tax. And that's exactly why strategic planning matters. So guys, as promised, here's the biggest mistake I see investors make when pursuing tax strategies. They focus on a specific strategy before determining whether the strategy actually fits their situation. The strategy itself is rarely the problem. The real question is whether the strategy fits the investor. That's why I approach tax planning very differently. Most tax professionals look at a tax return and see completed forms. As a CPA, EA, and a former federal government auditor, I look at the tax return very differently. I see patterns, missed opportunities, structured weaknesses, audit risk, and planning opportunities that may not even be obvious at first glance. Because I'm not just asking what happened, I'm asking what opportunities haven't been captured yet. And that's where strategic tax planning begins. The goal isn't simply to prepare a tax return. The goal is to understand what the return is telling us about the taxpayer's entire financial picture. Most tax professionals focus on preparing the return. I focus on what the return reveals. Hidden inside many tax returns are missed deductions, planning opportunities, entity decisions, timing opportunities, and wealth building strategies investors never knew were even available. And that's why tax planning isn't about collecting random strategies. It's about understanding which strategy fits the taxpayer sitting in front of you. If you are a real estate investor looking for proactive tax planning and would like to explore how these strategies may apply to your situation, you can schedule a consultation using the link below or scan the QR code on the screen. If you found this video helpful, please be sure to like, subscribe, and share it with another investor who may benefit from hearing it. Thank you for watching, and I'll see you in the next video.